Hey guys, Lawsy back here with the options Brit. Now, before we get into today's lesson, a quick note. If you want to see these strategies live in action, make sure you follow me over on Twitter. Link will be down in the description. Right now I'm running something I'm calling the 10K Premium Hustle. My goal is to make $2,000 a month on options premiums for 5 months straight, just only through cash secure puts and covered calls, nothing else. The exact strategies I'm about to teach you about in this video. So if you enjoy what you learned today, and you want to follow along with my trades in real time, what stocks I'm selling puts on, what covered calls I'm writing, how much premium I've collected so far, jump over to my X page and hit that follow button. That way you'll see the challenge play out day by day, not just here on YouTube. Now, a quick disclaimer before we dive in. I'm not a financial advisor. None of this is financial advice. This is just for fun, education, to show you what I personally do with my money. All right, let's start with the first piece of this, the cash secure puts. I like to explain this with the idea of shopping and with the role of an insurance salesman. So picture this. You're walking down the high street and there's a shop you love. Let's call it Apple. You want to buy the latest iPhone, but you think the price is a little too high right now. Maybe it's $1,000 and you would only be interested in buying it for, say, $900. Now, here's the fun bit. Instead of just waiting and hoping, imagine someone actually pays you cash up front just for making the promise that you'll buy it for $900. If the price ever drops to that, that's a cash secure put in plain ye old English. You're basically saying, I'll buy this stock I like at a cheaper price if it falls. And while you're waiting, the market pays you money, called a premium, for being willing to make that promise. It's literally like getting paid to go shopping. Now, you might be thinking, why would anybody pay me a premium just for that promise? Flip the perspective. Imagine you're the person already holding the stock. Say you bought $22 and it's now trading at $25. Nice profit, right? You want to protect those gains in case there's a pullback, but you don't want to sell those shares. So you buy a put at a strike that matches your sleep at night level, for example, $24. That strike acts as a guaranteed stop loss or a safety net. If the stock tanks, you can still sell $24 no matter what. You pay a small premium for that insurance. That's why someone is happy to pay. They're locking in a floor under their profit. Now, come back to the other side, the cash secure put seller. You're the insurance company. You sell the $24 put and collect, say, 50 cents per share, $50 per contract, because remember, options trading, we are talking about 100 shares per contract. If the stock closes below $24 at expiry, you buy the shares at $24, but your effective cost basis is $23.50 because you already collected 50 cents per share. That's why I say cash secure puts are like getting paid to go shopping. You're either getting paid to wait or you're getting the shares you wanted at a discounted price. Now, let me show you an example of a cash secure put trade live. So we're going to go for 29 days out and we're going to look down the put side over here. Now, we'll be looking to buy Robinhood around about the $90 price because in my view, that's pretty much where we want to be. So we would come down to the puts, we would find the $90 strike price, and we would click 227. So now, live, we would be collecting, you can see down here, $231. We can change that by putting it to the mid price, $2. So you'll see the bid and ask prices here, 229, 236. So we're going to go somewhere in the middle, 237. We would then submit that offer, and we are saying that we are willing to buy Robinhood if it drops to $90 or below, and we will get paid $237 in premium to secure our money for those 29 days. That is the principle of your cash secure put. Now, let's move on to the second half, the covered calls. This one is even easier to picture because it's literally like being a landlord. Imagine you're in a house. You don't want it sitting empty, right? Collecting monthly income and make your property work for you. That's exactly what a covered call is. Except instead of renting out a house, you're renting out shares. Here's how it works. You already own stock in a company, let's say 100 shares of Apple. You agree to rent it out by giving someone else the option to buy it from you at a higher strike price. In exchange, they will pay you a premium upfront, straight away. Two outcomes again with this scenario. If the stock price never reaches that higher level, you keep the rent money and you still own the house, the stock. If the stock does go above that level, they might buy the house from you at that agreed price, but you still keep all the rent you're collecting along the way. You might be wondering, why would anybody pay me for the right to buy my stock at a higher price? Again, let's flip it around. Imagine there's a trader who thinks nvda is going to go up big. It's $120 today, and they think it might shoot up to $140. Instead of buying the stock outright They come to you and just pay you a premium for the option to buy it at 130 later. For them, it's like putting down a small deposit to lock in a potential deal. They risk losing just the premium, but if the stock really does fly, they get to buy your shares at $130 and enjoy the upside above that. So in the landlord analogy, the tenant is willing to pay rent because they see potential value in living. For the trader, the premium is the rent. They're paying you for the chance to capture bigger profits in the future. And that's why you get paid. You're giving them an opportunity, and in return, you collect a steady income. Just like a landlord doesn't care if the tenant moves out after 6 months because the rent has already been collected, right? Let me put this into numbers. Say I own 100 shares of nvda at $120. I sell a covered call with a strike price at $130. Someone pays me $200 for that promise. Two outcomes. nvda stays below the $130 strike price. I keep the $200 and still own the shares. nvda jumps above the $130. They buy my shares at $130, but I still get to keep the $200 premium plus the gains that I made from the $120 price up to the $130 price that I sold it for on the contract. So it's a win-win. You get paid twice. You're constantly collecting rent from your stocks, just like a landlord collects rent from tenants. All right, now that we've gone through what a covered call is, let me show you how I actually set one up live. I've got here 200 shares of Robinhood, ticker symbol HOOD. Is trading currently around $106. Now, if you followed this stock, you'll know it has a strong retail following and it has a tendency to really fly on good news. Because of that, I'm going to play it safe with my strike choice. I'm going to pick the $125 strike price above the current price. That way, if Hood does rip higher, I'm happy to sell my shares at $125. But if it stays below that level, I keep both my shares and the premium. For the expiry date, I'm going with the third Friday of the following month. In this instance, that's the 19th of September. It's usually the most liquid expiry date, which means tighter spreads, better premiums. Now, let's place the trade. So we'll go on down on the call side to find the $125 strike price, and the sell price is at $225. That means that when I click this, we are saying that we are willing to sell our shares of Hood at $125 if it reaches above that within the next 29 days. You can see down here, we've got one contract for 29 days at $125 strike price. They are going to pay us a mid price of $231 for that, okay? Now, we've got 200 shares of Hood, so we can do this twice, and we're going to. So we'll click another one here, and we now do two. That then puts our premium up to $454 mid price, or $458. The market's live at the minute, so these prices will fluctuate, so bear with me. We will now review the trade, and we are going to be increased by $461 worth of buying power. We're all happy with that, so we will submit the bid. There we go. We got filled straight away. Absolutely brilliant. Come down to our brand new trade, the two covered calls for the 29th of September at $125 strike price. Okay, we've just netted a nice little $460 profit there. That will be put up on X later and go straight towards our 2K challenge, which, disclaimer, it's put us over. We've made it. So whether or not Hood hits $125, I've just been paid front for owning those shares. And that's exactly what a covered call looks like in action. Now, here's the magic. When you combine these two strategies, cash secure puts and covered calls, you get something called the wheel strategy. Let me explain it step by step in plain language. You start by being the insurance salesman. You sell the cash secure put and you get paid while you wait to buy the stock you already like. That's important. You have to want the stock. If you end up buying the stock, great. Now you move to step two. You switch roles and you become the landlord. You sell the covered calls on the stock that you now own, collecting the rent month after month. You can do this continuously if the stock doesn't reach the strike price. If eventually your stock gets sold away because the price rose too high, that's fine. You go back to step one and sell another cash secure put, and you rinse and repeat the process. That's why people call the wheel strategy the money printer. You're either getting paid to wait or you're getting paid to hold. There's never really a time when you're not collecting an income from this strategy. It's not about being flashy, it's about being consistent. And that's the key to building passive income over time. So there you have it. Cash secure puts and covered calls explained. Cash secure puts are like getting paid to go shopping or being an insurance salesman. Covered calls are like being a landlord renting out your house. Put the two together and you got the wheel strategy. One of the simplest and most powerful ways to generate cash flow in the US stock market. And don't forget, If you want to see me actually running these plays week to week, check out the link in the description and follow me on X. You'll see my 10K premium hustle play out in real time, every cash secure put, every covered call, and the exact premiums that I am collecting. If you did find this helpful, guys, please smash the like button and hit the subscribe button. Follow along as I share my own trades, my own journey, and how I'm building income through options. Thanks for watching. I'll see you in the next one. Goodbye.